Okay, cool.
Here we go. We got it here.
Okay, yeah, let's get it started.
We got it. Watch this. And you'll do it afterwards.
Are you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust. It works for primary homes. It works for investment real estate. It works for highly appreciated public stock. It works for private stock. It works for collectibles, artwork. It works for Bitcoin, cryptocurrency. And it's literally, I think, the best kept secret. And not only that is it's new to people, but it has a track record of thousands of closes now, right? At over 25 years, 15 times no change IRS.
My mind was blown, and it's too good to be true. It's too good to be true. My CPA would have told me about it. My commercial broker would have told me about it. No, we didn't know about it at Marcus and Millichap until 10 years ago, and now we know it.
But I'll tell you, you made me a believer when we got the wire from our mutual client who made this work. And it was a real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty what do you call it? Hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
So using the deferred sales trust allow them to hold on to those assets. I mean, obviously they're, the legal structures around them, they're not in their names, but now that chunk of money is a cow in their farm, a really nice cow that does some really amazing things tax-wise and allows them to get the income that they need in order to meet their expenses. It's going to extend the length of time that they're going to have income by a pretty wide margin.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty and free up your hand to negotiate at whatever time you figure is appropriate. And it allows you to sit on the sideline, or it allows you to accelerate when needed and accumulate your capital.
So I found you, just so your listeners know, on a podcast, and I'm like, wow, this guy is really leaned in. He's articulate. He's very smart. When I worked in 1031 exchanges, we didn't really talk much about DSTs. We just used them to sort of round out a 1031 exchange. And I never knew that it could be the only solution that you need for a primary resident to take their capital gains and defer it and put it into another property. That was like mind blowing for me to understand that concept, which I learned on the podcast that you were on.
Over our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The deferred sales trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing?
Yeah, so I'd say be early and connect with us and just clarify your vision for what you want your wealth plan to be. And that's just not just your wealth, but that's your time and your energy. That's where do you think the market's at? Like, do you think it's a buyer's market, right? Do you think it's a good time to buy? Do you think it's a good time to be in debt? And if so, just keep buying real estate right now. But if you think it's not, and perhaps you want to wait on the sidelines and have some liquidity, get out of debt and wait for what we call a deal to hit you over the head, then that's why you would use the deferred sales trust, regardless if you're a baby boomer or if you're a professional. But essentially, if you connect with us, we're going to help you map out a wealth plan. And as part of that wealth plan, we're going to write a line down the middle of a piece of page, and we're going to say, continue as you are with the 1031 exchange, or continue as you are with the deferred sales trust, or a mixture of both. And we're looking at all of the pros and cons side by side, and then let you decide what's best for you.
All right, Stefan, I'll pass it back to you.
All right, cool. Yeah, thanks for the intro video there. So hi everyone. So we have here Brett Swarts today. So it's a pleasure to have him on the show. This is Finance Meets Real Estate. As you guys know, we do weekly webinars every Tuesday. So today, Brett is going to talk about the one secret to raising capital from cryptocurrency owners, or that one can learn from cryptocurrency owners. He's the founder of Capital Gains Tax Solutions, and he helps individuals sell and break out of capital gains tax jail, so to say, not a literal one. So yeah, with that, I'm going to pass it on to Brett. And if you guys have any questions, feel free to speak up or put them on the chat. And yeah.
Absolutely. Hey, thanks everyone so much for being here and investing in yourself and your future, and also for your clients and potential partners, and or for yourself. And we're going to title this presentation, "The Number One Secret to Raising Capital from Crypto Millionaires." And it's how I helped Peter, who's a client of mine, to finally achieve relief from retirement when it helped him sell $7.5 million in Bitcoin and Ethereum, and to help him defer about $2.5 million in capital gains tax without using a 1031 exchange. And so my name is Brett Swarts. I'm the founder of Capital Gains Tax Solutions, where we focus like a laser to help you and or clients defer hundreds of thousands to millions of dollars in capital gains tax. In other words, escape capital gains tax jail. As a legal disclaimer, this message and this presentation is for educational purposes only and is solely intended to provide an overview of how the deferred sales trust works and can be implemented. Capital Gains Tax Solutions does not provide legal, tax, professional services, or advice. Each transaction and individual circumstances vary widely, and participants are strongly urged to seek independent legal, tax, and professional advice. So what are some of the facts? And these are actually very staggering to consider. I don't know if you guys know this, but Bitcoin has had a market capitalization of about 1,072 billion as of February 21st, 2021. The highest number of global daily Bitcoin transactions in Q1 of 2021 was or is about 367,000. And between 2012 and 2020, Bitcoin has gained somewhere around 193,000%. That's a lot of gains to defer. The market size for cryptocurrency will get to 1,087 million by 2026. I think the estimates right now are about $3 trillion globally for all cryptocurrency. As well as the kind of the user index for 2021 shows a 97% confidence in cryptocurrencies. As the other thing to consider besides just cryptocurrency, by the way, is baby boomers, right? And baby boomers have amassed a lot of wealth as well. And everything I'm going to be talking about today also applies to sales of primary homes, businesses, real estate, stock, okay? In fact, there's about $17 to $20 trillion of wealth that's going to transfer from baby boomers to the millennials in the next 18 years. In fact, there's about 77 million baby boomers that are starting to retire in the U.S. alone. And every day, about 10,000 of them are turning 65 years old. And these baby boomers own highly appreciated assets, including cryptocurrency, but mostly primary homes, businesses, investment real estate that have had huge gains over the last 20, 30, 40 years. And realize that most of these assets that they own are not 1031 exchange eligible. In fact, 1031 exchange are not eligible for public stock, private stock, cryptocurrency, primary residences, business sales, right? They're not eligible. 1031s only work for investment real estate. So every single day, your clients and or partners are reluctant to sell because of the capital gains tax of 30 to 50% of their gain. Okay, and so there's literally cryptocurrency millionaires sitting here, maybe watching this right now, who have not sold or will not sell until they find a solution to this capital gains tax, which means what's for you? Well, if you can help them solve this problem, they can invest with you, okay? And that is the key to this whole presentation, how to unlock the capital so that you can raise money from cryptocurrency millionaires for potentially investing with you, okay? It's not a forced thing. They have to make that decision, and along with the trust, and we'll explain that, how that all works. It's got to be based upon their risk tolerance and a number of other things. But every single day, high net worth cryptocurrency owners, primary home, business, stock, and investment real estate owners pay hundreds of thousands to millions of dollars in capital gains tax when they don't have to. And they feel trapped. They feel frustrated. Why? Because of 30 to 50%. How do we get that number? Well, federal is about 20. It's soon to be maybe 26, 20, 25, 26, 28. State, and then Obamacare, and then depreciation recapture, depending on the asset. Now, cryptocurrency cannot be depreciated, so a better number for this is probably around 25 to 35%, kind of in that range is the typical number, but it can get up to 50% or higher when we deal with real estate. So I just kind of want to give you that range. So that means for every $1 million that a cryptocurrency owner has in gain, they're looking at either somewhere between $250,000 to $350,000 of tax if they were to exit, okay? So a few things before we get started. I want to encourage you and let you know that it's okay to dream of helping your clients or partners defer millions of dollars in tax and becoming the number one in your profession, or the number one problem solver for investors, the number one person who can attract and unlock opportunities because you're solving problems. And I think this is really important to understand as well. It's more important than ever to unlock new deals, new value, and be in the business of solving your clients or investors or partners' problems, not just selling another thing, right? And this is where the deferred sales trust will help you to separate from a lot of the old way of doing things. And so who is this for? Well, we'll mention it one more time. It's for anyone. If you or your investors or clients has a highly appreciated cryptocurrency, Bitcoin, Ethereum, NFT, business, investment, real estate, if they have a failing 1031 exchange, primary home, stock, public or private. You saw Kevin Harrington there in the beginning. He's from Shark Tank talking about public stock. And I have a whole episode where we go into the deferred sales trust and we talk about his story about buying stock at like pennies on the dollar, or being invested in stock, and the stock going to 20 something dollars per share, and having that huge amount of gain and a huge amount of tax, and him not even knowing what the deferred sales trust. And that's Kevin Harrington from Shark Tank. In fact, I'm coming out my book, and he'll be one of the first chapters, and that's what we're covering on the book there. So now here's the key, though. That asset that you're selling or considering selling, or your partner or client's considering selling, it needs to be big enough to make sense, okay, for the deferred sales trust, which means it needs to be about $1 million gain and $1 million net proceeds, okay? $1 million gain and $1 million net proceeds, net of all the debt and closing cost. It's got to be about $1 million, and that's on a per transaction basis, except for unless you're in cryptocurrency, because I have some clients that have 10, 20, 30, 40 coins that combine to that. Then there's a way to work with that. You just need to contact us to do that. But everything else is basically, you need to have at least $1 million gain, $1 million net proceeds, unless you have just two assets at $500,000 each. Two assets at $500,000 each to equal that $1 million, okay? So first of all, what is a deferred sales trust, and why do I need one? A deferred sales trust is just a way to defer capital gains tax on the sale of highly appreciated assets. It's based on a tax code called IRC 453. You know it as a seller carryback, or when a seller finances somebody. It is not a Delaware statutory trust. It's also not a 1031 exchange. Okay, this is why it's so flexible and it can work for all asset types. Okay, it's also kind of like an IRA, or kind of like a 401k. Just like an IRA and a 401k is not a 1031 exchange. IRC 453 is the tax code for this, if you're wondering. There's IRC 401k. Guess what? There's IRC 1031. These are all different tax codes that the government gives us as individuals to be able to defer tax, to do the things they want us to do. As long as we do it in the right order, in the right way, we can defer the tax. I want to use this analogy throughout this presentation, which is this: Blockbuster versus Netflix. And Stefan, do you remember going to Blockbuster at a young age? Do you remember having to rent a movie? Do you remember having to walk up to that Blockbuster, right, and actually sit down and or park and drive in there, and then you see it behind that cardboard box, Stefan? But when you go to walk up, it's gone. Do you remember doing that?
Yeah, I never did myself. I grew up in Eastern Europe, so no.
Oh.
Yeah.
Did you have
But,
something like a Blockbuster? Maybe it was a video store, maybe, yes?
Yeah. I get the concept of Blockbuster.
Yeah, and you have to go, and people, sometimes it would be checked out, and you're like, oh, it's checked out. You have to get a different one. You have to drive back and return it. You have to rewind it. You remember all of that?
Sure.
What was your place called, by the way? I'm curious.
I don't think there was a big chain for that. There were like small places you go to and so forth to do like all the video, like movie borrowings and stuff like that.
Okay, cool.
It wasn't a big.
Yeah, it wasn't big, but the key was it was pretty inflexible, right? And I don't know if it was tough to drive, if it was cold there or whatever, or you have to park, do all this stuff, and then they may be checked out, and you got to return it within 3 days, and you got to do all of these things just to get a video, right? And then you have to rewind it back in the VCR days. And then the DVD would be scratched, Well, that's like the 1031 exchange or the old ways of tax deferral. They're very restrictive. They're not flexible. It's like kind, 45 days, 180, to identify. The whole entity must move. There's a lot of challenges. Another thing came out called Netflix, and we liken the deferred sales trust to Netflix. There's no timing restriction. There's no returning. There's some ongoing fees, right? But the movies are never checked out. You don't have to go into like kind real estate. It works for cryptocurrency. Right. It works for business sales. You can dollar cost average. You can go into passive investment real estate deals with yourself or partners. You can do a whole lot of things. You can buy deals by yourself with no timing restrictions, right? Which is like the most amazing thing about the deferred sales trust. And that's why Netflix is taken over and the old video stores are gone. Okay. And so my goal for this presentation is to encourage you to understand why the deferred sales trust is the number one growth strategy you need to be focused on in 2020-22. How to grow your business with the DST, even if you don't have any capital gains tax knowledge, right? Or a ton of time. You're saying, I'm not a CPA. I'm not a tax person. This stuff is, I'm going to help you to keep it really simple, okay? And how to use the deferred sales trust to drastically increase your sales and conversions immediately or raise capital immediately, okay? So as a quick background, I started out at a young age, building real estate with my mom and dad, rentals, 1031s, brokerage at a young age. I was immersed in the Bay Area, Silicon Valley days, Steve Jobs, all the new Apple computer, all of that was like where I grew up. Okay. And I learned about wealth, and I also learned about real estate and being an entrepreneur. Okay. And then I had a chance to go to college and play basketball and scholarship. And during that journey, I took an internship at Marcus & Millichap. For those who don't know, it's one of the top commercial real estate brokerages in the world, specializing in real investment sales. Like multifamily was my expertise, and it still is my expertise. Okay. And I'm currently still a multifamily broker, and I invest and I raise funds and I broker deals. Okay. And I've closed over $200 million. It's actually $350 million now. Deferred sales trust transactions, multifamily deals, retail leasing, land, senior housing. I've done all this cool stuff. 1031 exchanges. I've done Delaware Statutory Trust. Okay. Of course, I've done deferred sales trust. I've been featured on a ton of media. You can look through all these different folks here. One that I'm most proud of is being featured on Sharkpreneur podcast with Kevin Harrington from Shark Tank, which is pretty amazing. And again, I'm coming out with my book here, and Kevin's going to be one of the first chapters. All right. But guess what? It wasn't always easy, guys. I wasn't Leonardo DiCaprio just cold calling people and closing $1 million deals. In fact, I was one of the guys in the back scratching my head like, how in the heck are these people closing these deals? It was 2006. I had been successful in everything I had done up until that point. And I started to get some momentum. I mean, you go into I call it the boiler room, right? You're cold calling, you're underwriting properties. It's 100% sink or swim type of environment. And my cousin was closing deals, and he was encouraging me. He was teaching me. He was mentoring me. And I was one of the guys going, man, I just wish I could figure this thing out. And I started to get some momentum. I started to build some confidence. I started to get things moving. And then all of a sudden, I don't know if you guys ever remember this, but something happened in 2008. And it was like a brick wall, like boom, I just crashed in a lot of ways financially. And I found myself in a position where my wife and I are at home with our baby daughter trying to figure out a way to keep the lights on and food on the table. And I don't know if you've ever been so scared that you're not sure how you're going to provide for your family, but that's where I was. In fact, I grew up with wealth for a period of my time in my life, but then my parents got divorced, and that's the other part of the story. My parents get divorced 10 years into their marriage, and we go from having a lot of wealth as a family to basically having like no wealth with my mom, living 90% of the time with my mom, still seeing that wealth with my dad, learning a lot of great things, but none of that wealth was shared with my mom. And so we were living with my grandmother in a very, very low income situation. We always had enough, but I knew what it was to see both the Harley Davidsons, the boats, the travel, the fun, all of the cool stuff, the Corvettes. And then I'd go back with my mom, and we barely had a van that could run, right? And we had to share a car, and we'd have to fill up gas with $5 at a time because my mom couldn't afford to fill up the entire tank at a time. And I just knew at a young age that I didn't want to have that stress financially for my family. I wanted to make enough that we could feel comfortable and not have to worry about margin. And so this thing hitting the wall was literally hitting the wall. There was credit card debt. There was moving with my brother in his small condo. There was like breaking down crying, and I don't cry because I'm so scared about how I'm going to provide for my family. And I told my wife, I said, we have a couple ways to do this. I go, it's 100% sink or swim. I love the business. I want to stay in. I think this is the future for us, but it's going to be lean for a couple years. But if we stay in, we can be ahead of the game here, but it's going to take some sacrifice. And so I asked her, would you move in with my brother? She said, yes, but what are you going to do? I said, I'm going to get a side job hustle. I'm going to do whatever it takes, and I'm going to get a side job working at Cheesecake Factory. And so that's what I did. By day, I'd cold call and help my clients negotiate with banks because they were going through their struggles, their difficulties. They had 1031 and overpaid for properties. And by night and weekend, I'd work at Cheesecake Factory serving cheesecake. I'd wear the same tie at Marcus and Millichap that I wore at Cheesecake Factory. And it was a very humbling experience, right? But I say this because this is a part of my journey, and you might be here right now trying to figure out a way to break through for your first deal, for your first opportunity, to raise that first $1 million. Whatever it is that you're trying to achieve, realize that the success you see in me today wasn't without the blood, sweat, and tears and the sacrifice of my family and us to stick through this, okay? And so this is my actual manager here. His name's Kerry. He's smiling on the right-hand corner. He was wonderful. And he goes, Brett, I'm not going to hire you because you're going to leave here in 2 months, aren't you? I go, what do you mean? He goes, you're going to close a deal and get a $50,000 commission. You're going to walk out. And I said, I promise you, Kerry. His name is Kerry. I said, Kerry, I will not. I said, no matter what I make at Marcus and Millichap, I will stay here. How long do you want me to stay here? He says, 2 years. He goes, I don't want to train you and you leave. You give me 2 years. I said, no matter what, I will stay here for 2 years. And so that's what I did for 2 years. For 2 years, I learned at Marcus and Millichap. I grew as a person. My manager brought in a gentleman to speak on the Deferred Sales Trust. And like you, for the first time, I was sitting where you're at right now in 2009 going, is he telling me there's Netflix? Because we've been doing Blockbuster. I mean, we're the Navy SEALs of investment real estate, 1031 exchanges. I mean, we know this thing. We're the best, right? He's telling me that we have Blockbuster and he has Netflix. And I said, if what he's saying is true, this will change everything, right? But what I was running out was time. I was running out of time because I didn't have any money. So I had the Cheesecake Factory on the weekends. And by day, I'd make cold calls. And I did that for 2 years, okay? I moved with my brother to a small condo. Then I got multiple other side jobs, too, to keep the lights on. But guess what? After persevering and starting to implement the Deferred Sales Trust and what I'm teaching you, my business started to grow. I started to get in front of people that I never would have gotten in front of. I started to solve problems and look at things in a new way, think differently, right? In a new way, and also assess what actually happened, that people had overpaid for 1031 exchanges. They had been doing Blockbuster, and all of a sudden, they were losing half or everything of that they had built up for the last 10 years or 15 years, if they were over-leveraged, if they weren't buying value add, right? And so all of a sudden, my business starts to grow, and fast forward, it's now, 2022. My wife and I, we have 5 kids. We live in California. We're on the front line of taxes and helping people defer them every single day. And now I coach and train and teach Marcus and Millichap agents, Keller Williams agents, Colliers International, cryptocurrency influencers, financial advisors, CPAs on how to do this. But when I started out, I didn't know what I was doing, right? But it took the blood, sweat, and tears and the 10,000 hours to figure this thing out. And I want to help try to give these secrets to you right now. Okay, so after 10 plus years, I discovered the hard way. How many of you want to learn the easy way? And please, please, please type in the chat, yes, I want to learn the easy way. Yes, I want to learn. Tell me where you're from, right? Tell me if you own cryptocurrency. Tell me if you know someone who owns cryptocurrency. Put it in the chat and let Stefan and I kind of absorb that as we go along here. And also, as you have questions, put them in the chat, okay? And we're also going to stay around and help you answer these questions. But by the way, if you've been struggling, this is probably why. The perfect storm. The perfect storm of cryptocurrency being at all-time highs, stock market being at all-time highs, real estate being at all-time highs, as well as this massive amount of gain that we've seen in the past 5 years of cryptocurrency, 10 years of cryptocurrency. Massive, massive amount of gain, okay, along with real estate as well. And by the way, the other perfect storm is this, that things can change and they can change rapidly. Just like we saw in the 2017-18 crash of cryptocurrency. It went up and then it crashed down. Real estate crashed in 08, 07, 08, 09, up and then down. Right? Stock market, we saw COVID-19. There's a lot of these things that want us to, are encouraging us to get out, okay? And by the way, it's not your fault that you haven't heard of this. Your CPA doesn't even know about it. Or if they do, they're probably working with us, okay? Or number 2, they've heard of it, but they get it confused with the Delaware Statutory Trust. Or they're so busy at what they're doing that you haven't encouraged them to come talk to us. And, they just don't know. And they're not like, you know, the 10,000 pages of the IRS tax code, not everyone can read every single page, right? By the way, 1031 exchange companies also don't want you to know about this, okay? This is also, I learned this the hard way. At Marcus and Millichap, although my manager brought in the gentleman who's now my business partner, who played for the 49ers, who's the co-founder of this, who's amazing, okay? He brought him in, but the next manager told me to stop talking about it. I'm saying, what do you mean? Like, don't you want people to know about this? And what they really wanted is to keep our clients in the 1031 hamster wheel. Just getting that big commission on that next deal, okay? And again, the cryptocurrency doesn't even apply for 1031. You don't even have a 1031 option, but I'm just telling you this so you know the backstory of how I got here, okay? And that's the shotgun wedding. You get engaged in 45 days, you got to get married in 180 days, and it's a really, really, really kind of a mess, right? In fact, this is the hard way. The hard way is the 1031 exchange. What we've been forced to do for the past 10 years. Again, it doesn't even apply for cryptocurrency, but you got to do all this other stuff here that can create a whole mess. But what I want you to understand, the biggest thing about the connection here with crypto and the 1031 is time, right? The 1031 exchange forces you to buy in the same market, and not having a solution to cryptocurrency millionaires to sell high and buy low forces them to either stay in or not get out at optimal timing, which is the foundation of what we believe here at Capital Gains Tax Solutions, is to be able to buy and sell and build your wealth at optimal timing. Have the freedom to build your wealth when it makes sense for you, not because of a tax deferral strategy. And that's also why the inflexible way, and I call this is the Hollywood video for those who had those growing up. We had the Blockbuster on one corner, and then down the street we had the Hollywood video. The Delaware Statutory Trust is just another form of a 1031 exchange. It's just a Hollywood video. So there's all kinds of things why it's not great. But the biggest thing is you're tied up for 7 to 10 years. You're not diversified. Huge fees, okay? And but it can also solve some cool things. No more toilets, trash, liability. It can also solve mortgage over basis. But the biggest thing is there's typically not value add deals, which is really about buying B and C properties and increasing the rents by forced renovations, forced appreciation, right? And that's where we found most of our clients really love. Okay, so you can look up the 7 deadly sins and why Delawares typically don't have value add. Okay. So I'm going to walk you through how to deliver a transformational exit plan for cryptocurrency millionaires right now. But first, I want to tell you a couple of deal stories. All right. So this is one of the first ones. This is, in fact, the first one we did. We did this about 120 days ago. And this is a gentleman who lived in the East Bay area, okay, near San Francisco. And he's working in the Silicon Valley for about 20 years. And he understands and gets the technology and the future of Ethereum and Bitcoin. And so he started to invest at an early adoption rate state. And he bought it for about $100,000, okay, combined, mostly Ethereum, but also some Bitcoin. And he saw that appreciation go up to $13 million, okay? $13 million. But that wasn't without the highs and the lows. In fact, at some point it was at 6 million, then it went down to like 500,000, and then it went up to 9 million, and then it went back down to like 3 million, and then it went up to 13 million. So it's all these ebbs and flows. And that created a lot of stress and a lot of turmoil for his investing, and also some stress with he and his wife, because he's like, you know what? She wants to sell all of it. I see the future, but there's all this tax, and they basically felt handcuffed because of the capital gains tax. And so they basically came to a compromise, and the compromise was this: when we find a suitable capital gains tax solution to our capital gains tax problem, we will execute some of the assets. And so that's exactly what they did. And their dream, by the way, was to own investment real estate, partly up in Lake Tahoe. Anyone ever been to Lake Tahoe? It's beautiful. And here in Northern California, one of our dreams for about anybody, they'd love to have like a cabin right on the lake, right? A big old cabin overlooking. And that's when I sat down with them and I said, what do you want to do with the funds? And this is really important to understand. Just because you can defer tax for somebody doesn't mean they're going to invest with you. Okay, just because you can defer tax to somebody doesn't mean that you have a good plan that you've articulated and show them with the underwriting and the opportunity. That's where you need to have not only the way to exit tax deferred, but also where the funds are going to land. And so they said, yes, we do want to buy that. That is our dream, but the prices are so high. In the meantime, they're going to put it into the stock market, and that's what they've done so far until the prices go lower. But they have their capital ready, and so they exited $5 million, deferred about $1.85 million of tax, and that was never been done before with the deferred sales trust. We were the first ones to do it, and the only ones to do it so far with the deferred sales trust. Okay, so that was the first deal story. They're really happy. Oh, by the way, he was able to retire from his corporate job. He's no longer having to build the dream, trading time for dollars. He's no longer on the left side of the quadrant, rich dad, poor dad. He's now on the right side. He's a business owner and an investor. He's not having to trade W-2 time for dollars, right, to keep his lifestyle, to spend time with his family. He can travel more, okay? He's done forever from that, okay? And this is awesome. He's also going to be starting a new business venture into the cryptocurrency world, as well as buying investment real estate. It's really an amazing, cool story, okay? But it wasn't without the skepticism and all of the other things, okay? And the second one we did was for a Google employee as well. Now, she's in her 20s. Now, check this out. This is one of the most inspirational stories I know of for investing. This is about, I don't know, maybe 60 days ago, okay? 60 days ago. And she gives me a call, and she says, hey, look, we found you on YouTube. This seems too good to be true, but we're open-minded, okay? Walk us through how this thing works. I said, well, let's make sure you qualify. Let's make sure you have at least $1 million net proceeds, $1 million game. She goes, I have much more than that. I go, well, how much? She goes, much more. I go, okay, well, you tell me when you're ready. And so we go through the whole conversation, and then finally at the end, she goes, okay, I'm going to tell you. Okay, what is it? Well, we got about $50 million of Bitcoin. Oh my gosh, $50 million? Yes. Okay, how much did you buy it for? $50,000. I go, oh, wow. I said, how did you have the titanium spine to hold on through all of this? She goes, I just understand it, and I get it. I have the conviction of it, but I never wanted to sell because of the capital gains tax. I go, you never sold? She goes, well, I first bought Bitcoin first day, it was like $5,000 or something. And it went down 8% the next day, and I got scared, and I sold it all the next day. But then I bought again a couple of weeks later, and since then I'd never sold. I go, serious? She goes, yeah, I'm in it for about $30,000 to $50,000 total, went to $50 million. But Brett, here's what I want to do. I want to go invest with a partner of mine into a business venture. All tax deferred. Can we achieve that? And if so, I'm willing to exit $5 million of my position today. And so that began the journey of understanding how to do this. And so she exited $5 million of her $50 million and deferred all the tax. And that was Bitcoin. She's only Bitcoin, okay? Which leads into the third deal, which was another $2.5 million of Ethereum and Bitcoin, a mix. And so, plus here's another one we did with Steve. Steve was a client of mine. We saved his failed 1031 exchange, $1.7 million sale, deferred $350,000 of tax. We call him Skeptical Steve, and he doesn't mind me saying that. He's a good friend of mine because he's very skeptical, and he should be, and you should be too. For anyone who's bringing a new tax deferral strategy like me, you should ask all of the questions. But here, through education, there's empowerment here. And so he says, Brett, I can tell you it wasn't easy. I had to really dig in. I had to somehow pivot and trust someone else. I'm a very skeptical person, and my wife is even more skeptical. And you can watch his entire podcast interview. I interview him on this whole thing at capitalgainstaxsolutions.com. Here's another deal in Silicon Valley, $8.3 million primary home for one of the number one Keller Williams agents in the history of Keller Williams. His own home right here. He did it. Okay, he's very skeptical too. Here's another multifamily property in Colorado, $5.1 million sale. Here's a marketing business, $2.6 million out of Alabama. Here's a $7.9 million deal in Santa Cruz. Here's a multifamily deal for a guy who's worth $40 million. We saved his failed 1031 exchange. Here's another one for $7.6 million deals out of Georgia. We saved his failed 1031 exchange. Here's one for some multifamily syndicators. They have about 3,000 units now. They've done it for 3 properties now, but they did it for 2 of their properties worth $36 million out of Nevada and Arizona. And so I'm going to share about how to do all this, okay? And by the way, here's the number one secret to overcoming the biggest objection to a deferred sales trust. And this is probably what everyone's thinking right now. Brett, wow, the DST sounds amazing, but I need my trusted advisor to say yes before I move forward or before my partners or investors move forward. I just don't understand why my CPA doesn't know about this. And I'm going to help you right now how to tell 2 deal stories to instantly gain credibility, even if you have no DST, knowledge or tax deferral experience, okay? And it starts right now. Stefan, you ready?
Yeah.
All right, Stefan. All right. So this guy's named David Young. So you may not know David Young, but you know like a Mark Cuban or know of a Mark Cuban, right? You might know of a guy named Bill Gross. You ever heard of a guy named Bill Gross?
I haven't.
Okay. So Bill Gross is kind of like a Mark Cuban of the financial advising world. And David Young was his right-hand guy. And they built a company called PIMCO. Have you ever heard about PIMCO before?
Yes.
So one of the biggest money, wealth, management in the world. They manage money for some of the wealthiest people in the world, okay? And for about 20 years or 15 years, David and Bill, along with 4 other guys across the world, built PIMCO from 80 billion to 1.2 trillion. They completely did an amazing job, and they crushed it. They got a big payday. They all kind of retired for a couple of years, and then David and 4 other guys get back together. Now, Stefan, if you can imagine, if you're like a Mark Cuban or a David Young or a Bill Gross or top of your line, there's probably going to be people there to come at you and try to sell things to you, right?
Sure.
So David Young gets approached with the Deferred Sales Trust 3.5 years ago. And like most things, he's skeptical. He's cautious because he's seen this song and dance from a lot of people over the years. And he gets approached and he goes, you know what? This sounds a little bit different. I'm open-minded, but I will do some due diligence. So he didn't do a 2-day due diligence or a 2-week due diligence or a 2-month due diligence. He did a 2-year due diligence with his legal team, CPAs, flew back, met with the tax attorneys, talked with the banks, talked with the clients, look at the investments, look at the performance, look at all of the things that you could think of for a guy who is a chief investment officer and former executive VP at PIMCO. Okay, and this is what he found out. 2 conclusions after this. He said, Brett, that's the smartest person I've ever met. And that person not being me, that person being the tax attorney who's my business partner. Okay, and number 2, we're all in. We will offer this to our clients. We will be part of the inner circle of the Deferred Sales Trust. In other words, we will put our name on this. Okay, and so this is the question, Stefan, for you, and maybe for anyone else who's listening right now who's a skeptic, and I understand that you're a skeptic. I was there too. If it's good enough for David Young, Stefan, and his legal team after 2 years of due diligence and managing some of the biggest wealth in the entire world for over 30 years, some of the best of the best of the best, is it good enough for you and your legal team?
Likely.
Okay, I got you to likely, right? I got you to skeptic to likely. I'll take it, okay? Likely. And by the way, bring in your CPA, bring in your people, right? We don't want to just replace them. That's not what we want to do. You continue to do your personal tax planning with them. But bring them in to ask the tough questions. We're a team. We're gonna work with them. But I want to encourage you guys. But I doubt they're going to do the level of due diligence that David did, putting his name on the line, his team's name on the line, his firm's name on the line, becoming a part of the inner circle. Okay, I doubt they're going to do that level of due diligence for you. And I want to put you with David. In fact, you can watch David's entire story. Just go to capitalgainstaxsolutions.com and hear his entire story. Hear him tell it. Okay. All right. Number 2. This is the second story. Okay. So remember, all I want you guys to do here is just tell 2 deal stories. The first one is David Young. Second one is Cal Garvin. Okay. Cal Garvin. Now, Cal is the traditional financial advisor, 35 years in the business. But he's not only just a traditional financial advisor, he's one of the top at LPL advisors, okay? Very, very cautious, and this is his own deal that he's doing it on, okay? He's considering it, and he gets approached with the Deferred Sales Trust. He's been in the business for 35 years. He's living in California, Los Angeles. And he has this huge book of business, multiple $1 million of business, and he's thinking about selling it for his own business, okay? And he's skeptical, right? He's not sure. And so he also sees that he could sell today and retire what it would take him another 10 years after tax to retire if he can use the DST, if the DST is legal, if it works. So he's looking at it, but he has an ace in his pocket. What's his ace in his pocket? It's his wife. And his wife is even smarter than him, and he'll be the first one to tell you. His wife actually works for the Secretary of Treasury. She's been working, she has worked with the IRS and other people that are doing things they shouldn't be doing. So he comes home one day and he goes, honey, I got this stack of paper right here. And it's this thing called a deferred sales trust. And I'm going to let you know, babe, that like I'll never do anything that you don't feel good about or comfortable with. And I told you when we got married, if you say no, it's a no. I had no problem, okay? But I want to let you know that our dream is to leave out of California, to move to the Midwest, to spend more time traveling and not working so much. And I just want to let you know that if this thing actually works, that we can exit our business right now. And I'll sell it now in the next 30 days. I'll be out of here if this actually works. But if it's not legal, if you don't give the approval, the red stamp, a green stamp, right? I don't want to do it. And I'll just go back to work, no problem. But here's the information. So would you do me a favor? Would you just go to the people that you work with, and would you just do what you've done in the past for 20 years? She's a G5 attorney, a G4 attorney. Like a general has like a 4-star general, his 4 stars. She is so high and so respected in there, and she's amazing. She works for the government, okay? And she goes, sure, honey, I'm open to that. This is stuff I do like on a daily basis. So she takes that stacks of paper and she goes in. I don't know if anyone see the show Suits before. Stephanie, you see Suits? You know what that is? There's like the mentor. His name is what's his name? His name is Harvey Specter. And then like his mentee is Mike. Anyone see that show? And they're these top attorneys, and they come in and they throw the book down on these big things every time there's a big statement, and they have a piece of paper, they just stab it on the thing. Well, he goes, Brett, it was like a movie. Like she came in from work 48 hours later, and I'm at my desk in my home office, and I turn around, she comes through the door, and she takes the stack of paper and she puts it on my desk, and she says 2 words that changed my life forever. She says, it's legit. Everything stopped. It was like slow motion. He goes, he couldn't believe it. He didn't think it was going to be, he thought it was going to be too good to be true. And I said, Cal, what happened? He goes, I sold my business. Within 90 days, I'm out of there. I sold it within 90 days. We moved out of California. He goes, Brett, that was 15 years ago. I said, Cal, would you come on my podcast and share that story? He goes, I don't like coming on podcasts. I don't like coming on video. I go, but people can call me. If you have a live deal, they can call me and I'll personally talk to them. I love telling my story. He goes, Brett, but I want you to tell them these 2 things before they call you. Tell them this. Ask them this question. Do you think my wife and I would put our financial legacy, our career legacy on the line for something that wasn't legal or we felt wasn't going to work? I've worked 35 years. This is our financial legacy. This is our retirement. She's worked 20 years with the government. Do you think we would do something that we didn't think was 100% legit and all in? So here's the question for you, Stefan. You went from skeptical to maybe. Now I'm going to ask you the next question. If it's good enough for Cal Garvin and his wife after her scenario, I think it was 48 hours, right? It's a little quicker. Due diligence, but she's a G4 attorney for their own multiple $1 million business sale. Is it good enough for you and your legal team?
Sure.
Oh, I got a sure. Okay, a little bit higher. Okay, I like it. All right. But this is the key, right? Once you understand these things and the track record of thousands of closes, billions under management, lifetime audit defense, literally perfect. Batting 1,000. Biggest deal was a $125 million deal in San Diego. You name it. Car dealerships, dentists, orthodontists, veterinarians, multifamily owners, self-storage owners, retail sales, hotel sales, stock. From some former Netflix employees had a lot of stock that they sold, public stock. It becomes really, really simple and really, really clear and really, really easy. So what's step one? Step one is simply this. Map out a wealth plan. Get with Stefan, okay? What is the plan for your wealth? Why aren't you exiting your position? What if you could be passive? What if you could be active? What if you could be earning cash flow on a diversified investment real estate portfolio and a mixture of some stocks and bonds and mutual funds? What if you could sell high and buy back into crypto whenever you want? Sell high and buy into real estate whenever you want. Okay, map out what that would mean for you and your family and for your wealth. And get with people like Stefan to map all that out. And then simply get with us, okay, and walk through and form a DST. That's step one. Step two is to transfer the asset to the DST, and the DST sells the asset. Okay. Step three is to fund the trust and receive a promissory note. Understanding what's happening here. You're becoming the lender. You're not the owner of the asset anymore, the owner of the trust. You're lending the funds to the trust, and we're going to show that here in a minute. And then step four is to enjoy your wealth. Give more. Invest. Start a new business venture. Go into a partnership deal. We have a client in Alabama who sold a $2.6 million business. He's building 70 multifamily units, all tax deferred from the ground up with the trust. These trusts are typically structured as 10-year promissory notes, and you can renew every 10 years for 10 years. You pass it to your heirs. They're typically set up at 8% interest, net of all recurring fees. You can also cash out and pay the tax whenever you want. Okay? Also, there's no limit. We can do $1 billion deal. We can move all the funds outside your taxable estate without giving it all away to charity. That is our proprietary way we do that as well. So how does this whole thing work, Stephanie? Are you ready to participate?
Yeah, sure.
All right. So let's imagine you have $5 million of Bitcoin that you bought for $1. Okay. And so let's say you're going to pay tax of about $1.88 million. Okay. So instead of just selling the assets directly to a cash buyer or an exchange and receiving the cash directly and paying this tax, we're going to set up this trust to come in right between you two, okay? And this trust is going to buy the assets for $5 million and immediately turn around and sell it for $5 million. Or another way to put it is you're going to transfer the $5 million of Bitcoin, let's just call it, into the trust, a brand new trust, single entity trust that only does business with you, all protect it, okay? And immediately the trust is going to sell it. Coinbase, we use Kraken for $5 million. $5 million is going to go into the trust account, and you're left with a promissory note. It owes you that $5 million plus a rate of return of 8%, all tax deferred. So in other words, Stefan, you received $0. So if you receive $0, how much tax is triggered on zero?
0.
Got it. And Stefan, if the trust received it for $5 million and turned around and sold it for $5 million, how much gain does the trust have if it sold it for the same price?
0.
So how much tax does the trust owe on zero?
Yep.
Okay, perfect. You get it, right? So what you're left with is a $5 million promissory note at 8%, due and payable in 10 years. It could be interest-only payments. Most of our clients are living off 5 to 6%, and they're paying tax on the interest. Ordinary income tax. If they dip into principal, it pays tax. So you say, well, Brett, how do I... So any questions on that, on how that just works, Stefan?
Yeah, so the promissory note for the notional in question, let's say like $5 million here. So are there any limitations to doing that? Like, can you do it for any, like you mentioned, you can do it for cryptocurrency, you can do it for, if it was like to save a 1031 exchange, if and so forth, right?
Yeah.
So can I just sell, literally sell any asset and place it in a DST and have a promissory note and defer it by 10 years?
Yes, as
There's
long as the
no-
asset's $1 million net proceeds and $1 million gain, as long as it's qualifying, right? Meaning it's big enough, then yeah, and then you can just keep building it on top. So you could have a $5 million to start, then you can do another one for $2 million, do another one for $1 million, another one for 500,000, and you just keep building it into the trust. It's one trust, and it just keeps getting bigger and bigger.
And what are there requirements as for the reinvestment, like at the end of the promissory note period?
No requirements. I mean, you have to. The only requirements is if you're going to receive the funds, you're going to pay the tax. But if the funds are invested into real estate or business, which is really the next step, right? Like, let's say you had an LLC here, Stefan, you had a 200 unit apartment complex, right? The trust can invest. If it's an active investor, like let's say it's a GP, it can invest into a small LLC, and then it can invest with you. Or if it's a passive investor, it can just go directly into the trust. Okay. We got to keep some diversification and some liquidity, right? So we can't put all 5 million in. We typically are making sure we're not over concentrating, but and we're diversifying the wealth into different assets. Okay. But yeah, it can absolutely do all of this.
So just for our audience and my understanding also, so to your point, let's say the promissory note is 10 years in this example, or 5 years? Or,
10 years. It could be 5 years. It could be 10. Yeah.
Right. So the funds which are invested, so there's a promissory note for 5 million, then there are the actual funds which are in a 5 million DST, right? Deferred Sales Trust.
Yeah.
Is that correct? Okay,
Yes.
sure. So the 5 million which are in the DST, like what are the requirements for getting those invested? Like because you mentioned an example of like somebody investing in a business venture and so forth. So what are there constraints to that?
Yeah, so if you're an active GP, up to 80% of that 5 million can go into an LLC. So let's just call it 4 million. If you're an active GP. So like if this is you're an expert in commercial real estate, you're an active GP, and this 4 million can go into another LLC over here. Okay, and now you're going to be an owner of this. Okay, you're going to be an owner in partnership with the trust, which is pretty cool. Okay, and so we call it the go fund yourself. So yeah, we have a proprietary way of how we do that, but we give you the majority of the upside, which is pretty cool. Now, if you're a passive investor, right, then depending on their risk tolerance, this 5 million would be could be. Let's say $1 million could go into this deal here. Then you have another deal over here for 100 units, right? And $1 million could go into that deal over here. And then you have, the stock market. You got to typically keep at least $1 million on the 5 million in the stock market, right?
Why?
So we need to be diversified investment grade securities and have liquidity for some of the funds. So what we found is in the past, if we don't have enough liquidity, the trust has got to be able to pay fees, and the fees are about 1.85 to 2% depending on the AUM. And so you need to make sure that we have enough liquidity. Now, it's still your money, still working for you. It's just not 100% into something that would be illiquid. Does that make sense, Amy?
That's fine, but who controls the investments of the trust?
So who controls investment? So you as the note holder must approve of all of the investments. So nothing moves without your signature. Now I'm the trustee. Understand that I also have to approve it. So it takes dual approval. So it's kind of like an IRA or a 401k or even like a 1031 company. Because Amy, you don't own the trust. You are a secured lender. You have to approve of all investments. So the funds never move without your signature. The funds are never invested without your signature.
But they're also not invested without yours, right?
Correct.
And so if you don't agree, then it doesn't go anywhere. Right?
Exactly. And if I didn't have that power, Amy, it'd be taxable, right? So now I'm a friendly trustee, and I want to be able to. I also have a fiduciary duty to do my best to pay back that 5 million at 8%. Right, over the 10-year period of time. And also, but even before that, we measure everything through what's called a risk tolerance questionnaire. And so, Amy, imagine it was your deal, right? You would fill out a risk tolerance questionnaire and you get a score. And based upon that score, the investments are an allocation is presented. And then based upon that, you either approve or disapprove, or you bring in someone like Stefan to say, hey, here's an opportunity here, or I have my own deal, I have another partner's deal. Let's bring it all to the table. And so the way we like to put this is like, you're the CEO, right? You make the final decision, but there's
But
also
I don't. But that's a lie because I don't. It has to be, you have to sign off on it and I have to sign off on it. So unless you're just going to do what I tell you to do, which is what I would prefer because it's my goddamn money, no offense. I mean, I don't, you know what I mean? I mean, I'm giving you control over
yeah. I understand what you're
whatever
saying.
money I'm putting in there.
So yeah, it does take my approval. Yeah. So, but it also takes your approval. So if you don't approve it or I don't approve it, nothing happens, right?
Mm-hmm. I know.
So in one sense, yeah, you have the final decision because if you don't approve it, nothing happens. But if I don't approve it, nothing happens. So if it didn't have that, and by the way, that's why I'm third-party unrelated trustee. It can't be your cousin or employee or roommate from college or whatever, friend. It has to be truly third-party unrelated. It's not unlike what a 1031 exchange, by the way. If you've ever done a 1031 exchange, you're working with a third-party intermediary that holds the funds until you execute on your trade. Okay, it's not unlike an IRA or a custodian in that there are some differences for sure, but there is someone overseeing it to make sure that they're following the guidelines. And so that's my role. I'm kind of like an IRA custodian. I'm kind of like a qualified intermediary. But yes, it does take my approval, and you do give up unilateral control. You cannot make unilateral decisions. Okay, but the key is this $1.85 million of tax. But what we like to say is we're helping you build a dream team to execute on this strategy, but also to invest and find great deals. So does that make sense? Or any other questions there, Amy?
Well, yeah. I mean, I get that, but self-directed IRAs, yes, there's a third-party mediator, but they just do what you tell them to do. I mean, all they're going to do is make sure they get the documents that they need. I mean, I'm a GP in a lot of the deals, right? So I have people who put in self-directed IRA money and self-directed 401k money and all those great things. It's fine.
Yeah.
But if I'm going to execute a plan and I'm going to do a deferred sales trust, no offense, I don't want you to have any control of what I do with my money.
Yeah. And by the way, that's the cool thing, Amy, is we do everything at no cost, no obligation. If for whatever reason you don't want to do the deal and you want to just pay the 1.8 million of tax, right, to get unilateral control, then that's great, right? Go ahead. Right. But what a lot of our clients do, Amy, which is pretty cool, right? They form an LLC at which you're the owner of that LLC. And since you're an active GP, 80% of the funds can go into the LLC the next day, of which you can go buy real estate with it. Okay. So I'll say that again. 80% of the 5 million can go into an LLC the next day, right? And which you can go buy real estate with it. So the question is, what are the odds that we say no to your real estate deal, Amy? So what kind of deals are you doing? What's the average return? Where are you buying it? What does that look like, Amy? I'm curious.
I'm a large multifamily syndicator. I buy deals in Texas and my returns average 20 to 30% IRRs.
So that's perfect, Amy. You're an experienced operator who's done deals. So there's next to zero chance that we would ever say no to that. So that means you would have the same amount of money the next day after you close, plus you have an extra 20% sitting in the stock market also earning interest. So then the question would become, well, Amy, if you have the same amount that we're already going to say yes to your deal on, that you're controlling, you're running, you're managing, and you have an extra 1.8 million sitting over here, right? Why wouldn't you do the deal? By the way, you still have to approve that 1.8 million. Right? So also you get a brand new depreciation schedule on that. So you're familiar with cost segregation in 27 and a half years on multifamily. You can also get a brand new depreciation schedule on that. So the key is getting to know us, Amy, right? Hearing about this for the first time, I get it, right? You're like, who is this Brett guy who has to say yes to these deals? I've made it all myself, right? But realize that once you get to know us and we realize that we're an ally or an asset, we're not in the business of saying no. And you can get the money into your own LLC and invest in your own deal the next day with the same amount. What do you have to lose? Does that make sense, Amy? Maybe not.
I'm sorry, I'm in the middle of something. I'll get back in a second.
Okay. All right. But those are good points, good questions. Appreciate those, Amy. Anyone else have questions on this? Go ahead, Stefan.
Yeah, so just from my understanding, so since you mentioned, I mean, like obviously, like the initial asset needs to be big enough, like needs to be $1 million more, and like the proceeds to be $1 million and so forth, and that, let's say, and you mentioned like some of the conditions could be split in some cases, and if it's cryptocurrency, maybe there's like some flexibility in like being split across multiple coins and that. But then once the funds go into a DST, are there limitations for how big those reinvestment assets need to be?
No, it just has to be suitable based upon their risk tolerance, right? So you could put like on this scenario, let's imagine this was a $15 million multifamily property, and it's going to take about a $4 million down payment, right? And then you could invest, you could leverage that, right? You could lever up, and then you can depreciate this 15 million on cost seg, which is amazing, right? So now you're using an extra $1.8 million that you would have paid to the government as a down payment to help you lever up on a $15 million deal, of which you can do cost segregation and depreciation on, and wipe out a lot of the cash flow and tax-free money. Like it's Netflix, right? Once you get it, it's Netflix, and it's amazing versus Blockbuster.
So let's say for a passive investor, like just for our audience benefit, let's say if so one sells like an asset that is worth $1 million and then wants to reinvest entirely passively. And so how is it going to work? Like just to give like a simple picture. So to your point, is there's going to be some liquidity that needs to be there. So 20% are going to go in the stock market, let's say, high level speaking. Then 80% go into 16 syndications of 50,000 invested in each, possibly?
Yeah, exactly.
Okay.
Exactly. It's all going to depend on their risk tolerance. It's all going to depend on their experience. Understand that I also want to point out that that if they are if the trust is passively investing into a syndication, then the depreciation does not go to it goes to the owner, which is the trust. Okay. Now the trust doesn't need it, but unfortunately, unless you're active, like Amy is, like it's her own deal, right? Or active GP. They, and if you can work out an active GP into a deal, then you can get it on your own personal tax return. You can get up to 80% of that depreciation. So I want to point out, that's a nuance there. So it's not as favorable if you're a passive investor, right? Versus an active investor into your own deal. It's a little nuance there. Does that make sense?
Wait, sorry. So in what sense it's not as favorable for a passive investor?
If the trust passively invests into a syndication with you, right? The depreciation doesn't go to the passive investor. It goes to the trust. But if you're an active GP and the trust invests with you via an LLC, that LLC depreciation that waterfalls down to that partnership percentage goes to that person. So like an Amy situation, right? Like let's say she had $5 million in a trust, and she's like, you know what? I want to put $4 million into my deal, right? She can form an LLC, and she can make it 80% ownership with her, and that means she's going to get 80% of the depreciation of what it's, let's say the deal up here is a $15 million deal, right? Because she's an active GP, and this LLC, as an owner of the LLC, that the trust puts up all the money, but she gets 80% ownership. This is the magic here. That means she gets 80% of the GP interest of what flows down to the LLC. So these are all specifics that we can work out with individual circumstances, but I'm just saying it's more favorable if you're an active GP. It's also amazing too if you're passive too, right? Like it's still good if you're passive. It's just not as great if you're unless you're GP active.
Mm-hmm.
Okay.
On the other hand, go ahead.
Okay, I have a question in terms of, so what does GP stand for?
General partner.
General partner. Okay, so in that regard, so it sounds like you guys are offering an infinite service to manage that trust as a friendly trustee, because
that's exactly what we do. Yeah, capital gains tax.
It looks like an infinite or perpetual money manager.
Yeah, exactly. Along with the financial advisor. So we'll work with the financial advisor, us as the trustee, we're separate. And then there's a tax attorney team that does the legal work.
Okay. So once you want to cycle out, let's say it's a generation later, I'm assuming what other measures can you implement for minimizing the tax burden if you want to cycle out within one generation versus deferring it to 2 generations later.
Yeah, I mean, you could go try to buy more real estate and do some cost seg on a $20 million deal, right? So you could try to get some cost seg, accelerate 25%, 80% of this is could be building value. And then that means, and of that next number, let's just say 16 million of that, 25% would be accelerated in year 1, 2, or 3, of which that might be, I don't know, it could be potentially 4 million. And then you could try to call it in that same year and then try to exit at the same time. So you have a wash event over here and over here. So, or you had a loss. Let's say you bought a deal for 20 million and you sell it for 16 million. So you had a loss. So the key is tax optimization. Take the money when it makes sense for you. Okay. The other way to pay for this thing has to do with income tax, right? So Amy might have a very high income and maybe not enough depreciation to offset. Like I had a client, he makes $1 million a year and he's mid 40s. And he's like, Brett, I don't need or want any income from the trust. I'm like, okay, let's delay the trust from paying you for a couple of years. And therefore his income tax went lower. Okay. He had another client, the one in Colorado, a $5 million deal, multifamily property. There were $25 million. Their motivations for this was, I don't want to touch any of the money for 4 years. So they delayed the payment for 4 years. They live in California. They had no depreciation on this property. So they were taking it was fully depreciated. So it was taking all the cash flow and they're just paying all the tax. So their goal was move all the equity into the trust, defer all the tax, but also defer the income from the trust. Let the trust just compound. The trust can act like an IRA in this scenario, in that all of the growth of the income and the capital gains from the investments can compound and grow. It operates in a tax neutral state on most years. Therefore, it's just growing tax free, and the client's not receiving any of that capital or any of that cash flow, and therefore their income tax is going lower. Does that make sense?
Yes.
Okay, so that's a powerful way. They can also establish residency in Florida or Texas or Tennessee or Nevada. Once they establish residency, I had another client move out of Palo Alto and moved to Nevada. Then he starts taking payments once he's in Nevada. Guess what? California, huge income tax. Nevada, 0. Okay, now it doesn't mean he can dip into principal and pay 0. It's still gonna follow him, right? If he dips into principal, he'll pay the capital gains tax of California, but the interest payments are ordinary income tax. So you delay, and then start pulling him out. So that's the second way to get the trust to pay for itself. Okay, the next way is moving the funds outside your taxable estate. So back to my client who's worth $25 million, all of that $25 million was basically all in real estate, and all of it was inside of their taxable estate. And they're in their mid-60s. That 25 is likely to get to 50 million, perhaps by the time they pass. But above 22 million married right now, 40% of whatever is inside your taxable estate is going to be hit with whatever is above 22 million is going to be hit with a 40% death tax. It has nothing to do with stepped up basis, nothing to do with capital gains tax. It's everything to do with your estate tax. Okay. And so for them, they looked at this as an estate planning. Oh my gosh, 2 million on one deal in one day without buying life insurance, without buying not doing charitable remainder trust. They sold, moved it into the DST, moved it outside their taxable estate. So that's the other way to make this thing an investment rather than an expense. Does that make sense?
Yes.
Okay.
Thank you.
So we're winding down. We're running out of time here. And I'll definitely go to answer questions. I just want to make sure everyone knows what they can do for next steps, and then I'll stay around to answer all the questions, okay? So remember, what investors or clients used to have to do: stay in millions of dollars in gain in crypto or real estate or whatever, GP positions, or borrow against their crypto assets, or give it away to charity, not sell a business, stock, primary home, overpay for a 1031 exchange property, become the lender for a single buyer, stay in debt, pay the tax. So it's a new way, it's a better way. I hope you're becoming more of a believer today, or at least moving from 0 to skeptic to maybe to sure, whatever. That's cool. Take your time. But step 1 is transfer it to the DST. Sell, defer the tax, fund the trust, invest at any time. That is the plan. tax deferred, dollar cost averaging, buy low, sell high, and keep doing that over and over and over again. So if this sounds like you and you want to help yourself or your clients or partners escape feeling trapped by capital gains tax and be able to invest with you or by yourself, then I want you to invite you to continue your educational process with me, journey with me by joining our mastermind every single Friday at 10 a.m. Pacific Standard Time, 1 p.m. Eastern, by going to capitalgainstaxsolutions.com. You can subscribe to our YouTube channel. We have David Young on there. We have CPAs come on. We have financial advisors. We have skeptics come on. We want to hopefully help you overcome the false belief of it's too good to be true, it's too expensive, I give up all the control. All of those things on the front end seem like it, but once you get to know us and understand the deals, I'm telling you, it's a Netflix way of doing things. You don't want to be stuck in Blockbuster. With that, I want to thank everyone for their time, and I'm going to open it up for any last questions.
So I just have a quick question, Brett. I'm just trying to kind of process. So would you say, let's say, from the perspective of, let's say, real estate general partners who are real estate professionals, so they have access to, other tax strategies as well, be it cost segregation with bonus depreciation, even though that's being modified right now, but it's still available. And then, like some of the other tools, tax tools that you mentioned. So would you say it's like a more compelling story for like sellers of stocks and cryptocurrency and other assets just because they have nothing else that they can do there whatsoever, or passive investors in real estate, even though in effect the DST is a little bit less useful to them for some reasons that you mentioned, but nevertheless the only available option that passive investors would have. And so like what would be your comment on that? And perhaps that
Yeah, absolutely. Right. So I love the 1031 exchange when I can find a deal that makes sense, that's a forced appreciation, that's value add, it's equal greater value, all of those little things. I've closed and sold over $100 million in mostly multifamily investments. So I absolutely love that. Okay. I'm a big fan of the 1031 in a buyer's market. Okay. But I hate when my clients overpay, let the tax tail wag the investment dog, and they're chasing deals that they normally wouldn't be buying if it wasn't for the tax that they wanted to defer. Okay. So we want to separate the tax deferral from the investment opportunity. Now, you're absolutely right. It only works for investment real estate. And they're also talking about taking it away. It looks like they're going to keep the 1031 around, but imagine they actually were going to take it away. Then this is the only game in town that we know of that's going to give you all the flexibility that you want. That's been tried and tested by the IRS. We've passed it. We're perfect audit protection and audit track record. But you're right. Cryptocurrency, stock, primary homes, businesses. That's the big thing for you guys. Like your clients, if they're mostly real estate, they own other assets. They own cryptocurrency. They own other assets. So give them something that actually is eligible. Like the 1031 does not apply to anything but investment real estate. That's why it's Blockbuster, right? That's why it's so restrictive. So yeah, you're right. Step one, if you're in a 1031 and you can find a deal, hey, you don't need to pay us any money. You maintain all unilateral control. You pay $750 to a qualified intermediary, high five you. You don't pay us anything, okay? But also don't go out swimming in the 1031 exchange waters without a backup plan. That's where we can save a failed 1031 exchange. You only pay us if we save it. You need to get with us. Not every qualified intermediary knows about this or knows how to do it. We have qualified intermediaries that work with us, okay? And so we also encourage you never go with a qualified intermediary that won't give you a backup plan to a deferred sales trust. I'll say that again. You never know what's going to happen, so never give them your money if they're not going to cooperate. Go with a qualified intermediary who will cooperate with the deferred sales trust, a Delaware Statutory trust, and a 1031 exchange. Does that answer the question, Stefan?
Yes, you did. You did. Okay, any last questions, guys? So Brett has been very generous with his time here. So if you guys wanna ask like last 1-2 questions, perhaps. Okay, so that
Amy's
was really
back.
great.
Amy's back. Go ahead, Amy.
Sorry. I was traveling to California. I just choked in I'm speaking at the IMN conference tomorrow or Thursday. And I was checking in my hotel and the lady's looking at me and she's like scowling at me. She's like, "Are you still on the phone?" I'm like, "No, I'm not on the phone. Hold on." So damn funny. No, I mean, there's a lot more than obviously you can, this needs to be like a 3-beer conversation or something. I'm sure there's a lot that I need to think about over it, but no, I just wanted to thank you for at least introducing the subject. I mean, Of course, I'm a sponsor, right? So I've heard of deferred sales trust. I've heard of them, and I need to get a little more educated on them. That's all. So I just want to thank you for your time.
And by the way,
Appreciate
Amy,
it.
come on my podcast and tell me your story, and let's do this thing live for 30 minutes, right? And we'll answer the objections. We'll do this like this. We're totally transparent. Right? That's the cool thing. Like we will. There's no bad questions. They're all good questions. I appreciate the fire, and I appreciate the transparency and the being straightforward. But I'm telling you, I felt the same way as you. I'm telling you, I grew up in a family. That's all we did: buy investments, own it, control it, do it all. That's my first love. Okay, and I'm not saying take that away. I'm just saying maybe it's a backup plan, or maybe it's the primary. Who knows? Depending on your deal, and you could you could turn your wealth into $150 million. How smart you are? Who knows? Maybe you're worth more than that. And then you're looking at estate tax and you're going, Brett, you're my best friend. I'm so glad I learned about this years ago because a 1031 doesn't solve that. So yeah, lots of application there.
Right,
but you're right. Just take bite-sized pieces and then let's connect offline. I love that, Amy.
Okay. All right. That's good. Y'all have a good one. I'm going to go find some dinner. I'll see y'all.
Bye.
Awesome. I learned a lot. Thanks, Brett. That was really, really informational. Good stuff.
Hey, thanks for having me. It's more my pleasure. Happy to add some value to everybody. I wish everybody well. And you can check out my book. It's releasing next month, okay? Building a Tax Deferred Exit Strategy, the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself and your clients. We have Neil Bawa. We have Kevin Harrington from Shark Tank. We have Dan Hanford, Joe Fairless. We have, who else is in here? We have Don Einhorn. We have Brian Burke. Okay, Michael Blanc. We have amazing people in here that are very smart. Okay, so I want to encourage everyone to get a copy of the book. Look for it to drop on Amazon in about 1 month from now.
Awesome. Thanks everyone for joining us. Have a good night.
Goodbye.